Welcome to Acera's pre-retirement seminar. In this seminar, I'm going to tell you all the things that you might want to know in the 3 years leading up to retirement, or maybe even in the 3 months leading up to retirement, or the 3 weeks leading up to it, depending on when you're watching this. Because you're going to retire soon. And as somebody who's going to retire soon, you probably have some questions. Questions like, what do I need to know? And what do I need to do, if anything? So I have organized this pre-retirement seminar into the form of a checklist, and I'm going to answer those questions for you as we go along while we tick off items in the checklist. So we're going to talk about, I'm going to help you understand your membership and some various aspects of some details about your membership, like your contributions, your retirement timeline, your tier. Okay, then I'm going to help you estimate your retirement benefit. So we're going to talk about the retirement formula that is going to be used to calculate your retirement benefit. We're going to talk a little bit about purchasing service credit. We'll talk about how vacation affects the salary component of that retirement formula. And people are always curious about that, so we'll dig deep into that. And then I'll help you use our benefit estimator tool on our website. I'm also going to help you verify your retirement eligibility, choose your retirement date, and actually I'll tell you all about the process that you're going to use to actually apply to retire and the different retirement options that you're going to be presented with when you go to retire. I'm going to help you understand other benefits like medical, dental, vision, and a few life events, and then we'll talk about signing up for Acera News. So that's the full checklist. It'll take us about 3 hours, so let's dive right in. First item on the checklist, understanding your membership. Let me go ahead and open the Q&A here just to make sure. And we have a comment, good morning and thank you. You're welcome, and good morning to you. Okay. Understanding your membership. Who is Acera? In one sense, Acera is just this acronym, the Alameda County Employees Retirement Association, Acera. But really, it's made up of a lot of people. So there are about 90 of us that work at Acera. And what we do at Acera is we provide retirement, disability, and death benefits to our members. And our members is all of you. You're also part of Acera. And you're a member because of where you work and the position that you work in. So you work, or at some point you worked full-time, and you work in a retirement eligible position. And you work in that position for one of these 6 public employers. These are Acera's 6 participating employers that use Acera as their pension system to provide retirement benefits to their employees. As an Acera member, you are contributing to Acera's fund. So every paycheck that you get, a chunk of that paycheck comes out, a sliver of it comes out, and goes into Acera's fund. And you can verify that by looking at your pay stub at the pre-tax deductions column, and you'll see a line that says retirement. And that is your contribution each paycheck to Acera's fund. Now, every time that happens, your employer is also making a contribution on your behalf to Acera's fund. And so we take that money and we invest it all over the world because we don't just want it to sit there. We actually want to earn some money on that. So we have a lot of investments all over the world, and we earn quite a bit of interest. And so those are the 3 sources of income. Your contributions, your employer's contributions, and all the interest that we earn give us this big pool of money that we call the Acera Fund. So what do we do with that money? Well, meanwhile, you are working in your full-time retirement eligible position, or if you went down to part-time, you're still in your retirement eligible position and you're still earning retirement. You're earning credit toward retirement while you work. And at some point in the future, you're going to retire. And what's going to happen is you're going to collect a retirement allowance each month for the rest of your life. You cannot outlive your retirement. It just goes on for the rest of your life. This is the retirement that you earned while you were working. Let me show you a few pension milestones that will help illustrate your membership with Acera. So your first milestone is your date of hire. This is the first day that they told you to show up to work if you got hired right in your full-time retirement eligible position. If instead you started out part-time or in some other capacity, this is the first day that you were starting work in that full-time retirement eligible position. Okay, then in most cases, 2 weeks goes by, and the first day of your second pay period is your date of entry into ACERA. So this is the first day that you start earning that service. I'm sorry, that first day that you start earning that credit toward retirement. That's your first day of membership in ACERA. There's a couple of employers, I think the Housing Authority may be one of them, where actually your date of entry into ACERA is your date of hire. So there's not that 2-week gap. But for most people, it's the first day of your second pay period. Okay, then 5 years goes by. Once you work full-time for 5 years, you're considered vested in the retirement system. And vesting, that word just means guaranteed. Vested means guaranteed. So when you're vested, you are guaranteed the vested benefits. You're guaranteed the guaranteed benefits, basically. And those guaranteed benefits include that retirement allowance that you're going to get every month for the rest of your life. Okay, then at some undefined, for the purposes of this milestone chart, point in the future, you will actually become eligible to retire. And we can't put an exact number of years on it because it's based on your situation. It's based on how many years of service you've earned and how old you are. And so there's some combination of those that get you to retirement eligibility. And I'll go into that in the second half of the presentation. Okay, so then after you're eligible to retire, at some point after that, you can choose to retire. So it's a date that you choose, and that is going to be your first day of retirement. So you're going to earn your credit toward retirement during your entire career all the way up until the time you retire. And then this is where you're going to start collecting that retirement that you've earned. And you're going to collect it for the rest of your life, every month up until your death. And then there's another milestone after your death, which is that for many of the retirement options, there's 5 different retirement options. And for most of them, you can actually provide for a beneficiary to receive a continuing payment every month after you die. And in most cases, it would go for the rest of their life. And so that continuing payment would go until their death. So those are all the pension milestones. Okay, I do have a question on the board. How do I check my balance of how much contributions you've contributed? You can do that by logging into your account on our website. So you go to acera.org and you press the account login button. Okay. Okay, at this point I want to introduce you to this retirement worksheet that I created for you. So this is your takeaway from this seminar because, like I said, this is going to be about 3 hours worth of information. And I find that it's easier to remember if there are certain key bits of information that you're able to write down as you go along. And so this is kind of a worksheet that helps you do that. That helps you kind of identify what your specific numbers are, what your specific situation is. So you may have already downloaded it. If you didn't, I'll show you where to get that. Let me switch my screen share here. Okay, so here's our website. And you just go under Retirement Planning Seminars, under News and Events. And you scroll down to Pre-Retirement Webinar. And then it's right here, Pre-Retirement Seminar Worksheet. So it's a PDF that you can print out and then fill it in as we go along. And so we're going to focus on this section first, but there's a bunch of other sections here with some numbers that you can fill in as we go along. And the idea here is that if 2 weeks goes by, 2 years goes by, 10 years goes by, and you are trying to remember what you learned at the seminar, this is kind of a record of maybe what you learned. Okay, so let me switch back to the presentation. If you already happen to know your ACERA entry date because you remember what it is, you can go ahead and write it in. And so you can fill this out as we go along, or you can come back and fill it out later if you like. Now, if you don't remember your exact entry date, I don't remember mine. It was 12 years ago. But you kind of remember like the month and year. You can write that in, or if you just happen to remember the year, you can write that in. If you want to know exactly what it is, you can log into your account on our website, and it'll tell you the exact date. Additionally, if you already have an idea of what your projected retirement date is going to be, you could pencil that in here. You may hear something during the seminar that may make you want to adjust that date a little bit. So, like I said, maybe you want to pencil it in at this point. Okay, really quickly about vesting. Like I said, it happens after you earn 5 years of service credit, which means that you worked full time for 5 years. But it also includes reciprocal service credit you earned under other systems that are linked together. And then the guarantee comes from state law. And then the vested benefits are the monthly retirement allowance for the rest of your life, and an annual cost of living increase. So it's a cost of living adjustment. It's an annual increase to your retirement allowance. And we'll talk more about that later. And there's a $1,000 lump sum death benefit. That's kind of like an additional benefit to some of the other death benefits that are available that go along with the different retirement benefit options. So now that you know your vesting date is 5 years after your entry date, you can kind of put that in here. Now the vesting date isn't super important because most people earn way more service credit than the 5 years. But if you kind of just want to add 5 years to your entry date, you can go ahead and do that in here. Okay, so let me tell you about your tier. You fall into one of these tiers. And it's based on your position and when you entered ACERA. So it's mostly based on when you entered ACERA. Now let me help you find which timeline to look at. So safety members are sheriff's deputies and probation officers and maybe some other sworn officers. So you would be looking at this timeline here. Everyone else who's not a safety member is a general member. And so you would be looking at this timeline. Now, if you're a general member for the Housing Authority or a general member for Livermore Area Recreation and Parks District, you want to look at these two timelines here. So Housing Authority here, Livermore Area Recreation and Parks District here. Okay, now the way your tier works is that your date of entry into ACERA determines your tier. So for example, if you're a general member who entered ACERA before July 1st, 1983, that would put you in Tier 1. If you entered ACERA on July 1st, 1983, all the way up to December 31st, 2012, that would put you in Tier 2. If you entered ACERA January 1st, 2013 and beyond, that would put you in Tier 4. And Tier 4, that date is the same for all of the different timelines. Now for the Housing Authority and LARPD, there's a couple of different dates between Tier 1 and Tier 2 and Tier 1 and Tier 3, different date cutoffs. And the other thing that I want to point out is for safety members, if you entered ACERA on October 17th, 2010, all the way up to December 31st, 2012, you had to make a choice between Tier 2C and Tier 2D. And that choice was made within 45 days of achieving your safety membership. And so if you don't remember which one of those you're in, or which one you chose, if you didn't make a choice, you were defaulted into one of them, whichever one is the lower one. And so you can log into your account on our website, and it will tell you which tier you're in. Any of you can log into your account on our website to figure out your tier exactly. Okay, so now that you know what tier you're in, or if you already happen to know, you can go ahead and mark it on the worksheet. If you're a safety member, you may actually have a split tier, which means you may have started out as a general member and then you became a safety member. So you can either fill out two worksheets, or you can just mark both of your tiers on the same worksheet. Okay, next item in the checklist, estimating your retirement benefit. So this is the retirement allowance that you're going to receive every month for the rest of your life after you retire. Your retirement benefit is going to be based on this formula here. In retirement, you're going to get a percentage of your highest working salary. So this is the salary that you were earning while you were working. You're going to get a percentage of that for each year of service that you work for Acera. As for one of Acera's participating employers. So this sentence here is kind of the English way of spelling it out, what this formula is telling you. So to help you understand both, let me give you an example. Let's say that the percentage of your highest salary that you're going to get for each year of service is 2%. Okay? And let's say that you work for 20 years. So you enter Acera, you work full-time for 20 years, which means you've earned 20 years of service credit. So your retirement allowance is going to be 2% of your highest average monthly salary for each one of those 20 years that you've worked. So that means that you're going to get 2% of your salary for each one of the 20 years. You're going to get 40% of your highest salary, because 2% for each of the 20 years equals 40% when you multiply it together. So you're going to get 40% of your working salary as your retirement allowance. So let's say that your working salary was $5,000 a month. So if we take 40% of $5,000, that's $2,000. So this was your working salary. You're getting 40% of it in retirement, and 40% of it is $2,000 per month. And this is your retirement allowance. So that's how that works. That's how the formula works. So before I move on, let me go back to the tier chart to answer this question. Is there a tier 2 for safety? Yes, there's actually 3 tier 2s for safety. There's tier 2B, tier 2C, and tier 2D. And which tier 2 you're in depended on when you entered Acera. And then if you entered during this period, it depended on which one of the 2 tiers that you chose. So if you don't know which one of those tier 2s you're in, then what you should do is log into our website. Log into your account on our website, and then it will tell you exactly which one of those tiers you're in. And then there's a question about furlough days. Okay. So I have a question. So the furlough days question, let me save until I talk about service credit. And then there's a question, how does the salary calculation work if you have 11 years general and 23 years safety? So if you're one of those safety members who has a split tier, you have 2 tiers, basically. You did some work as a general member, some work as a safety member. The way the calculation works is that we're going to do 2 retirement formula calculations for you. So if I go to the retirement formula calculation, we'll do 2 of these. And so we'll take your age factor percentage from your general tier, multiply it by the 11 years that you worked as a general member, multiply by your highest salary, and that gives us a dollar amount. Then the second calculation will take your age factor percentage from your safety tier, multiply it by the 23 years you worked in your safety membership, multiply it by your highest salary, and that gives us a dollar figure. In both cases, the salary is the same number. So it's your highest salary during your entire career. And then, so we do the 2 calculations. Those both tell us a retirement allowance amount for each calculation, and we simply combine the 2 dollar amounts and send you one check. So that's how that calculation works. Okay. And the salary calculation is gross salary. You are welcome. And then the question is, if you entered Acera September of 2001, what tier would that be? Is that safety membership or general membership? Because if you're a general member and you entered in 2001, that would put you in tier 2. Okay, if you're a safety member, that would be tier 2B. Okay, so September of 2001, that would be tier 2B because it's during this time period here. Okay, and there's a comment. Your account says General Tier 2 INT. What does that mean? That means you're a General Tier 2 member, so you entered Acera at this point. The INT just means integrated, which means that It's an abbreviation for Social Security Integrated, which simply means that you're paying into Social Security and you're gonna collect Social Security one day. The safety members don't pay into Social Security, and so they're non-integrated. And the Social Security doesn't really have an effect on your retirement allowance very much per se. There's like a slight effect if you're integrated, but that's what the INT means. Absolutely. Okay, so we left off here at the pension formula. So we talked about how the percentage of your highest salary that you're going to get for each year of service. Now I gave you an example, a general example, specifically what age factor percentage you're going to get for each, what percentage of your salary you're going to get for each year of service for you is going to be based on how old you are when you retire. So this is a sample age factor chart that we use to determine your age factor percentage. The way you find yourself on this chart is you simply look at your tier. So if you're safety, you look at over here on the right half. General, you look at the left half, and then you find your tier column. So if you're a general tier 2 member, you just look at this column and you forget all of the other columns. You don't need to look at any of the other numbers. Okay, so you just look at your one column. Now, the way it works is when you go to retire, we look at your age at retirement. So if you're a general tier 2 member and you retire at age 62, we come down here to age 62, we go over to general tier 2, 2.09%. This is the percent that we put in the formula for you. So we take this 2.09%, put it in the formula, multiply it by the other two factors, and that is how we calculate your retirement. This is the percent of your salary that you're getting for each year of service. Now you may notice a few things about this chart. One is that the numbers get larger the older you are when you retire. So the older you are when you retire, the higher the percent of your salary you're going to get for each year of service. Another thing that you might notice is that maxes out at some point. So the blue boxes represent the maximum age factor percentage you can get for the tier that you're in. So they increase and increase and increase all the way up until that maximum age factor percentage. So for example, at Tier 2 general members max out at age 65. 2.43% is the maximum percentage that you can get. If you retire at 65 or older than 65, you're going to get that 2.43% in the calculation for you. Another thing that you might notice is that there's a bunch of gaps here in the age column. I skipped a bunch of the ages because there's too many age factor percentage increases to put on the slide. And that's because the age factor percentages increase with every quarter year that you don't retire yet. And it's based on your birthday. So let's say that your birthday is January 15th. Well, 1 quarter after your birthday is April 15th. 2 quarters after your birthday is July 15th. 3 quarters after your birthday is October 15th. And then back to your birthday. So every time you pass one of those dates and you don't retire, you move up one notch in this chart and you get a slightly higher age factor percentage. So there's a slight increase for each one of those 3-month increments. And if you want to see what all those numbers are, all of the increments, you can find that on our website if you go to acera.org/age. Or you can just search for age factor percentages in the search blank on the website. Okay, so I think that's everything I need to tell you about the age factor percentages. Are there any questions on that before we talk about the service credit part of the formula and then the salary part of the formula? Okay, moving on. So we just talked a little bit in detail about the age factor percentages. So I'll tell you about the service credit now. You start earning service credit when you enter Acera. And you're going to earn service credit all the way up until you stop working. Now, if you go straight into retirement, it's going to be all the way up until the day before you retire. If you stop working and then defer your retirement to a later date, you're just going to be earning service credit all the way up until you stop working, because you earn service credit while you work. And there's a question about what retirement eligibility is based on. We'll talk about that in the second half of the presentation. Okay, so this is the time period where you're earning service credit. Now you earn service credit while you work. During your regular working hours, you're earning service credit. Okay. You work for 20 years full time, you earn 20 years of service credit. If you work for 15 minutes, you earn 15 minutes of service credit. And it's measured in years. So if you look at your service credit number, it will say like 15.86475. And all those decimal places are calculating your service credit down to the fraction of a day. Okay. So while you work, you earn service credit. Also, on your earned leave time, you earn service credit. So your earned vacation, sick leave, management leave, comp time, holidays, floating holidays, you're earning service credit during all of those leave times. So those do not count against you. And I did get a question earlier about furlough days. It depends on what the furlough day deal was, I think, whenever you were furloughed. But in general, those don't count against you. Like they try not to have those count against you. Like that's part of the deal. So you would not in general you would not be penalized on your service credit or I think your salary. And you're noticing that I'm hedging there, and I'm saying in general or I think. I'm not 100% sure about that. I'm maybe like 97% sure about that. I think the best way to answer that question would be to talk to the experts, and you can do that by calling into our call center during 9 a.m. to 3 p.m. business days of Pacific time. And the call center can answer that question for you specifically. They're the experts in all of these details. I'm kind of a generalist. Okay. And let me take this question up there when I start talking about the estimator. Okay, so you earn service credit during these times. Now there are some times when you don't earn service credit. And that's whenever you're out on leave without pay, you're not earning service credit. Whenever you purchase extra vacation, which is like you're purchasing more vacation than you earn, some of our employers will let you do that. When you're out on that purchased vacation, you're not earning service credit during that time. Okay, and you can't buy that time later. So that's the bad news. The good news is you got to go on vacation. You got to go on an extra vacation. And purchasing vacation a week here or there and going out on that vacation is not going to affect your retirement allowance that much. So it's like pennies. So I wouldn't worry about it. You don't earn service credit for a vacation that you sell. So when you sell vacation back to your employer to get cash, you don't earn service credit for that time, but you may earn salary credit in the equation for that time, which we'll talk about in just a moment when we get to the salary portion of this retirement formula. And also, you don't earn service credit for overtime, on-call time, and standby time. Okay. So in general, while you work, you earn service credit, and while you're on your earned leave, you earn service credit, and otherwise you don't. Now, there's a concept called purchasing service credit. And there's different categories of time that are eligible for you to purchase. And the kind of general description of this type of time is time that if circumstances were slightly different, you could have earned service credit for it, but because of whatever the situation is, you weren't able to. So then you can go back later and buy that time. And that includes like part-time work that you did for your employer prior to your full-time retirement eligible position. And we're not talking about contract work or temp time. For a temporary agency, this is just like plain old part-time work. That's purchasable. Or work for the county's temporary assignment pool, which is abbreviated as TAP. Or like project work before your full-time position. That's purchasable. That 2 weeks called days prior to entry, which is the 2 weeks between your date of hire and your date of entry into a SARA, is purchasable. Unpaid medical leave, disability leave, or military leave. When you return from that leave during your active employment, that's purchasable. Redeposits of prior memberships for when you used to be an SARA member in the past and you took a refund whenever you quit, you took a refund of your contributions and now you're back and you want to put that money back to get your service credit back. That's called a redeposit of a prior membership, and you can do that. Related, similar, is if you get divorced or dissolve your domestic partnership and your ex-spouse or domestic partner takes some of your service credit and contributions, and then they take a refund. Once they take a refund, you can put that money back, and that's called a redeposit of community property. And then other California public agency work, if you used to work for another public agency in California and you're not eligible for their pension system, you can buy that time as a service credit. So I don't take a deep dive into purchasing service credit in this seminar. We do that in our new employee and mid-career seminar, mostly because people at the end of their career tend not to purchase service credit. But it is something that you can do. All you have to do is pay for the service credit that you want included in your retirement by the time you retire. So if you want more information about that, we have more information on our website at acera.org/purchase. And I also recommend watching that portion of our new employee / mid-career seminar. And there are videos of that out on our website that you can check out. And so we take a deep dive into purchasing service credit during that seminar. And then there's a question: how up to date is the years of service credit posted in your account on our website? And it should be within 2 to 4 weeks of up to date. If there's a larger discrepancy than 2 to 4 weeks, then you may want to submit a service credit. I think the way to do it is you submit a service credit purchase request, and on there there's a way that you can mark to get a service credit audit done, and then our staff will go in and audit your file manually to make sure that we're recording all the service credit that you've earned. Sure. And if I'm telling you the wrong thing about doing it on the service credit purchase form, it may be a different form. You can call into our call center and ask them what the procedure is for that. Our call center phone number is 510-628-3000. So that's 628-3000 in the 510 area code, and that number's out on our website. Let's see. I have a question. FMLA, does it count as worked time, and is there a contribution during that time to Acera? So to answer that question, let me go back to this slide. FMLA stands for Family Medical Leave Act, and that's a federal law that says that your employer can't fire you for being out on extended leave under certain medical circumstances, and that includes medical leave for family issues. So the way it works is that if you're out on leave and you're going through your earned leave balances, like your sick leave and vacation leave and other leave balances, then you're already earning service credit for that time, and so that already counts. Now, if you run out of that leave and then you're just out on leave without pay, that may be purchasable if the medical leave is for your medical condition, not a family member's condition. So that would fall under this medical unpaid leave category, and that becomes purchasable. And it's all kind of under the heading of Family Medical Leave Act because of that federal law. So that's how that works. Okay, one more thing I want to say about service credit before I move on to talking about the salary component of the retirement formula is about what happens to your unused sick leave that you have on the books when you stop working and retire. So, if you go straight from active work into retirement, we will convert your unused sick leave to service credit. And when I say going straight from active work into retirement, what I mean is this. Your last day on payroll is the day before your retirement date. Okay? Now, you don't have to actually be in the office this day. You can be on leave. But your last day on payroll is the day before your retirement date, whatever date that you mark on your retirement application. And so this is your date, this is your resignation date that is on your letter of resignation that you give to your employer. And this is your first day of retirement. That's the date on your retirement application. That means that you're going straight into retirement from active work. And if you do that, we'll convert your sick leave to service credit on a 2-to-1 basis, which means you'll get half of your sick leave as service credit up to a cap. The cap is in your Memorandum of Understanding, which is abbreviated as MOU. Your Memorandum of Understanding is like the memo that determines a lot of the conditions of your employment that you have. So it's like an agreement that you have with your employer. If you've never seen that, you can ask your HR department for a copy. And there will be in there a cap on how much sick leave is convertible to service credit. Now, most of the MOUs, a lot of them, the cap is 125 days of sick leave. And so if that were the case, we would take 125 days of sick leave. If you had that on the books, we would divide it by 2, and we would give you 62 and a half days of additional service credit in the formula for you, which works out to about 12 plus work weeks, because it's not calendar days, it's work days. Okay. Now, and I got a question about unrepresented. The only cap that I happen to know off the top of my head is the unrepresented cap, and there is no cap. So if you're unrepresented, or you're ACMEA, because the unrepresented follows what ACMEA does, then there's no cap. Everyone else has a cap, and you have to look at your MOU to see what the cap is. But like I said, most of them are 125 days. So if you had 125 days of sick leave on the books when you went into retirement, or more than that, you would get about 12 more weeks of service credit in the formula for you, which is about a quarter year. So that's about 3 months worth of work. So that's pretty good. So that's what happens to your unused sick leave. Now, one more thing, if you don't go straight into retirement, if you defer your retirement to a later date, which means that you stop working and you don't retire immediately, then you just lose all your sick leave. So that's how that deal works. That's just the employer's rule for that. Okay, let's see, I have a question here. Okay, so for Alameda Health System employees, does sick leave include both paid time off and extended sick leave? Let me think about this. So I know that the extended sick leave is included in this equation. I'm not sure if the paid time off, if like half the paid time off is included in this. During the break time, let me make a phone call to one of my colleagues and see if I can come up with the answer to that. I used to know that, and I can't quite remember the exact answer to that. So let me come back to that question. Sure. Okay, so we talked about the age factor percentage part of the formula. We talked about this years of service credit. Let me tell you about the highest average monthly salary and how we calculate that. When you go to retire, we have all your payroll records on file in our database, because your employer sends those to us every time you get paid so that we can do this calculation. What we do is we go through all your payroll records and we look for what we call your final compensation period, which is your period of highest pay during your career. And when I say we look through it, our pension software looks through it and finds your absolute period of highest consecutive pay during your career. Now, the period that we're talking about for Tier 1 and Tier 3 is your highest consecutive 26 biweekly or 12 monthly pay periods, depending on how you're paid. Now, for Tiers 2 and 4, it's your highest consecutive 78 biweekly or 36 monthly pay periods. Essentially, for Tiers 1 and 3, it's your highest year of pay, and for Tiers 2 and 4, it's your highest 3 years of pay. In order to figure out the average, we simply we look at your total amount of pay during that period, and we just take an average of it by dividing by the number of months in that period. So for Tiers 1 and 3, we're going to divide by the 12 months in that period to get an average, and for Tiers 2 and 4, we're going to divide by 36 months to get the average salary. So again, we take your total pay, we divide it by the number of months in that period, and that tells us your highest average monthly salary during your final compensation period, your period of highest pay. Now, what salary is included in this calculation? And for all of these types of salary, we're talking about gross salary before any deductions are taken out. Your base pay is included, of course, in your compensation for the purposes of calculating your retirement. There may be some other types of pay that go in there. Those are sometimes called footnotes, and there are other pay codes that you have on your pay stub. Now, some of those may be included, some of those may not be included. And it's all based on what the law says about whether that's included or not. We've already made a determination for those, and we have them all listed out on our pay codes page on our website. I can't tell you off the top of my head whether one is in or out of the equation because there's like 1,000 of them. But if you go to that page, acera.org/paycodes, You can bring up the list for your employer and it'll say yes or no whether your pay code is in or out. You can find your pay code in the list. The one that I do know is overtime, and that never counts toward this highest average salary. Okay, there are two more types of pay that I want to talk about here. And so we're not talking to the Tier 4 members, because the law tells us that Tier 4 members cannot include any of this pay in the salary. We cannot include any of this pay in the salary for the Tier 4 members. But for Tiers 1 and 2, vacation sales and vacation cash out money can be included in this highest average salary calculation. Okay, so let me give you a detailed explanation of this, because I get a lot of questions about this, and the law tells us that we have to do certain things regarding this. And so what I have learned is that it's better for me to just explain how the whole thing works so that nobody is confused, okay? Because we have to, we have to include some of this in the calculation if you have this kind of pay. Tier 4 members, you can take a little snooze for maybe 10-15 minutes, okay? Sorry you can't include it, but when the state reformed pensions in 2013, they left Tier 4 members out of this. So what we're talking about here is the pay that you receive during your final compensation period. Now, for the vast majority of people, your final compensation period is at the end of your career, okay, because you're getting the highest rate of pay at the end of your career. There are a few people, though, that your final compensation period is sometime earlier in your career because you were making more money at some point earlier. And if that's the case, then we shift your final compensation period to sometime earlier, and then we probably wouldn't be talking about vacation cash out because that happens at the time that you stop working. But for most people, we could be talking about vacation cash out because your final compensation period is at the end of your career. Now, what we're talking about is that you earn vacation as part of your benefits that you get. And your employer, if you don't take that vacation, will compensate you for it by writing you a check. Now, if they compensate you for your earned vacation that you're not going to take while you're still employed, that's called vacation sale. That means you're selling your vacation back to your employer. And there's usually a limit on how much they'll let you sell per year. It's usually like 2 weeks or 3 weeks. But you can sell your vacation back to your employer while you're still employed to get cash. That's called vacation sale or vacation sell. Now, vacation cash out, also known as vacation payoff, that happens when you stop working. Often it happens for people who stop working and retire immediately, when you go right into retirement. But whenever you stop working, if you have vacation left over on the books that you haven't taken yet, they'll pay you for it at that time. They'll cash you out for your vacation that you haven't taken yet, and you'll get an extra little check. Or maybe in your final check, you'll get extra money in that final check. If that pay happens during this final compensation period, then that means we're looking at maybe including that in the pay that we're going to use to calculate your highest average monthly salary for the purposes of calculating your retirement. And we're looking at the total of these two types of vacation pay is what I'm trying to illustrate with this slide. So the total between what you sell and what you cash out, this is your total vacation compensation during your final compensation period. Okay, now the idea here is that if you are paid for your vacation, your earned vacation that you're not taking during that final compensation period, that means your total salary during that final compensation period is a bit larger. If your total salary during the final compensation period is a bit larger, that means your average salary over that time is a bit larger as well. Because your average salary, known as your highest average monthly salary or your final average salary, both, it's all synonyms, because that average salary is one of the multipliers in the retirement formula, if your average salary is higher, that means your retirement allowance is higher. That comes out of the formula. So the bottom line is that if you are compensated for your earned vacation during that final compensation period, it makes your retirement allowance go up a bit. Okay, let me help you verify your retirement eligibility. We're talking about this date in the pension milestone chart here. I'll talk about tiers 1, 2, and 3 first, and then I'll talk about tier 4. So to be eligible to retire, you have to meet one of these 3 scenarios. Your first option for becoming eligible to retire is that you're age 50, and you have at least 5 years of service credit, and you have at least 10 years of membership with SERA. Now, for most people who are working and going straight into retirement, if you have 10 years of membership, you probably also have 10 years of service credit. And so you just kind of think of it as working for 10 years and being over age 50, then you can retire. But not everyone's going to do that. Some people will work for the 5 years or 6 years, 7 years, and they're done working, but they're not ready to retire yet. If that's the case, you can stop working, but then you just have to wait an additional amount of time until you have 10 years of membership with SERA. So you're basically waiting as a deferred member. So we have active members who are actively working. We have deferred members who stop working but don't retire yet. They defer their retirement to a later date. And then we have retired members. And so you can retire out of deferred membership. But for the vast majority of people, you're over age 50 and you've been working for at least 10 years and you can retire. Okay. Now, if you have reciprocity with a different retirement system, these numbers include your reciprocal time somewhere else. So if you already worked somewhere else for 5 years, or let's say that you already worked somewhere else for 10 years, and then you come over here and work and you're over age 50, then you're already eligible to retire, even if you haven't worked here for very long. Okay, for option number 2, you can be any age, and you have at least 30 years of service credit as a general member or 20 years of service credit as a safety member. So you can be even younger than age 50 and retire at any age, as long as you have this amount of service credit. Option number 3 is that you can retire at age 70 with any amount of service credit. So it can be even less than the 5 years of service credit you need for option number 1. So as soon as you meet one of those 3 scenarios, then you're eligible to retire. And you can start thinking about choosing a retirement date if you are ready. Now for tier 4, your first option for becoming eligible to retire is that as a general member, you have to be at least age 52, or as a safety member, you have to be at least age 50, and then you have to have at least 5 years of service credit, and you can retire. And you don't have to do that 10 years of membership thing like the other tiers have to do. And then your second option is to be at least age 70 and you can retire with any amount of service credit, even if it's less than 5 years. And so that's how you become eligible to retire. So now that you know what your retirement eligibility date is, you can go ahead and write it in here in your pension, on your retirement worksheet. If you already know you're eligible to retire, you don't have to like figure out what the exact date is. You could just write in that you know you're eligible to retire. Okay, next topic. Let me help you choose your retirement date. We're talking about this date in the pension milestone chart here. So you're already eligible to retire, and then at some point you decide, it's probably time. I'm going to go ahead and choose my retirement date. So what things do I want to think about when I'm choosing my retirement date? Well, I think you're going to want to think about these 7 things, and I'll talk about each one of these one at a time. The first is, will you have enough income to retire? This idea is that before you go ahead and pull the trigger on retirement, it might be a good idea to just peek into the future to see what your life is going to look like in retirement, to see like what your income is going to be, maybe even calculate what your expenses might be. So a good way to do that is to go ahead and get that retirement estimate from SERA. Also, if you have a deferred compensation account or any other investment accounts, to be cognizant of how much additional savings you have there, and go ahead and get a Social Security estimate for how much the Social Security system is going to pay you when you're eligible to collect Social Security. And you can do that on their website. And then if you want to, you can think about post-retirement expenses. Now, what financial planners will tell you is that you're going to need 70 to 80% of your pre-retirement income in retirement to maintain your standard of living. So whatever you were making before retirement, you're going to need 70 to 80% of that income through the combination of your SARA retirement, Social Security, and any other savings in order to maintain your standard of living. So when I say you're peaking in the future, you're just kind of like getting an estimate of what these things are and seeing if you're getting close to the 70 to 80% income replacement. And if not, it might be time to like adjust your plans a little bit. Maybe live somewhere that's less expensive, or like work a little bit more to earn a little bit more retirement, or save a little bit more money, or so on and so forth. So it's just a suggestion. Like, no need to stress out too much about it. I will show you this spot on our site where you can dig into this a little bit deeper. If you go to our home page and you scroll down to this berry colored section called Ready to Retire, this is kind of this has some shortcuts to our Preparing to Retire section. And if you go out to the Choosing Your Retirement Date page, this kind of takes you through in detail what I'm kind of taking you through in summary right now. And let me see, is this the right page? Actually, what I'll show you is if you go just to Prepare to Retire and just go to the Preparing to Retire section. Let me see where that is. Okay, estimate your retirement income. That's the page I'm looking for. So this takes you kind of through getting an estimate. There's some links out to the different estimators. This helps you calculate whether you're achieving the income replacement. You can use the AARP retirement calculator to do that. And if you want to do a calculation of your expenses, there's a worksheet from TIAA that will help you do that. So that's just a suggestion. So going back to the PowerPoint. Okay, the second thing that you're going to want to think about when choosing your retirement date is perhaps these age factor percentage dates. So remember in the beginning of the presentation where I was talking about the percent of your salary that you're going to get for each year of service, known as your age factor percentage. So that's one of the multipliers in the retirement formula. And the fact that they increase with every quarter year you wait to retire based on your birthday. So for example, if your birthday is January 15th, 1 quarter after your birthday is April 15th, 2 quarters after your birthday is July 15th, 3 quarters after your birthday is October 15th, then back to your January 15th birthday. And every time you pass one of those days, as long as you're younger than the maximum age for your tier, you get a slightly higher age factor percentage, okay? So let's say that you're thinking about, let's say your birthday is January 15th and you're thinking about retiring on July 14th. Well, you can see that you probably don't want to do that, because if you work on July 15th and retire on July 16th, you're going to get a slightly higher age factor percentage. And it's the same with all of these quarter year dates. And so what I'm trying to illustrate here is, if you haven't yet reached the maximum age factor for your tier, it's just good to know what these quarter year dates are so you don't mistakenly retire right before one, when you could have just waited a few days or like retired next week, and then you pass one of these date marks and you get a slightly higher age factor percentage, which will actually increase your retirement allowance by a little over 1% just by waiting a little bit, retiring past one of these dates. Okay, now if you're going to retire midway in between these dates, it may not be that big of a deal. Maybe you don't want to wait another 6 weeks in order to retire. So all I'm trying to illustrate is like to get you to not retire right before one of these days and miss out on a slightly higher retirement allowance. Okay. Now the third thing that you're going to want to think about, and I'm going to take these 2 questions that are up on the board in a minute. The third thing that you're going to want to think about is perhaps the cost of living adjustment date which is April 1st of each year. So the cost of living adjustment, if you recall from the beginning of the presentation, is a vested benefit. So this is a guaranteed cost of living increase to your retirement allowance each year. And it is calculated based on the percent increase of the consumer price index for the San Francisco Bay Area. Basically, if prices in the Bay Area go up from December to December by a certain percent, that becomes the cost of living adjustment amount up to a limit. So for tiers 1 and 3, the highest increase you can get each year in your cost of living adjustment is 3%. For tiers 2 and 4, the highest cost of living increase you can get is 2%. But if inflation is larger than those maximum amounts, what happens to the extra percentage points? Well, we'll actually bank those percentage points for you for the future. If inflation in future years is lower than the maximum that you can get, then we'll take banked percentage points out and add it to whatever inflation is that year to get you up to your maximum. So for example, let's say that one year inflation is 5% in the Bay Area. Okay, so then we pay all tier 1 and 3 members 3% cost of living increase, and we pay all tier 2 and 4 members a 2% cost of living increase on April 1st. Now what we do for tier 1 and 3 members is we bank 2 percentage points for the future, and for tier 2 and 4 members we bank 3 percentage points in the future. Next year, let's say inflation is only 1%. So what we'll do is we'll take percentage points out of the bank to get you up to your maximum. Since inflation tends to be a little over 3% in the United States, our members after a few years tend to have these banked percentage points, which means that if you've been retired for at least a few years, then you tend to get your maximum cost of living increase each and every year. So that's how that works. We calculate all this stuff for you automatically. Now, regarding choosing your retirement date, one thing is that if you are in retired status on April 1st, you will get the cost of living increase for that year, whatever it is for that year. Or if you retire before April 1st, when April 1st comes around, you'll get the cost of living increase for that year. If you retire on April 2nd, you're going to miss that year's cost of living increase, but you'll get it when the next April 1st comes around and for every April 1st after that, for the rest of your life. But that does mean that sometimes people try to time it out to make sure to get that cost of living increase, and they don't want to retire right after it, so that they're missing it, which tends to make March our biggest retirement month, because people are already ready to retire, and they're like, okay, I'll go ahead and retire in March, or I'll just retire on April 1st, and I'll go ahead and get that cost of living increase, which happens immediately, and I'll just have it from here on out. Okay, the fourth thing that may be a consideration when you're choosing your retirement date is if there's a conflict between the age factor percentage date and the cost of living increase. So let's take that January 15th birthday example again, because it's nice and easy to illustrate this. And let's say you're a general member, you're age 54, and the reason I'm giving this example is because it means that you're still younger than the maximum age factor percentage for your tier. And you're already thinking about retiring in the spring. So you think, let's see, my quarter year age factor percentage increase date is April 15th. So should I retire on April 16th, or should I retire on April 1st? If I retire on April 16th, I'm going to get that age factor increase from passing April 15th, working on April 15th and retiring at least on April 16th or after. But I'm going to miss the cost of living adjustment that I would have gotten had I retired on April 1st or before. Or should I retire on April 1st and I'm going to get the cost of living adjustment increase for April 1st, but I'm going to miss that age factor increase that I was going to get in another couple of weeks by passing April 15th. Which one should I do? Well, you probably already know the answer to this because I already gave you the percentage points. But if the cost of living adjustment is the maximum for that year, and we always know this in early February and we post it out on our website, then you would go with the cost of living increase, because that's going to increase your retirement allowance by 2 or 3% immediately versus a little over 1% increase you would get for the age factor increase. So there is a short in any case, there is a short period after April 1st where it would have been more advantageous for you to retire on or before April 1st. But it quickly resolves itself because you earn more retirement, credit toward retirement, as you go along. So in this example, if this person, rather than retiring on either of these two dates, decided to retire in the summer, like after July 15th, which is another quarter, they would go up one notch in the age factor percentage column for April 15th. They go up another notch for July 15th. And so they get those increased percentages in the formula for them. And then they would have worked another 3 months and earned 3 more months of service credit. And all those things combined would give you a higher retirement allowance than the cost of living increase would have given you. And so after a few months, then you're earning more in retirement than you would have had you retired on or before April 1st, or right around April 1st. And there's nothing really magic about April 1st. Like if you retire in September, when April 1st comes around, you get the cost of living adjustment. If you retire in July, when April 1st comes around, you get the cost of living adjustment. Okay, so this is really only this dilemma is if you're only retiring in the spring and if your birth date falls, in a certain way. If you're already older than the maximum age factor for your tier, you don't even have to think about the age factor percentage age because you've already got the maximum age factor percentage. So you just retire whenever you want. Okay, and then the fifth thing that you're going to want to think about, and I'll get to your 2 questions in just a minute, is specific to choosing which exact day you're going to retire. You're going to want to think about some things. If your intention is to go straight into retirement from active pay status in order for us to convert your sick leave to service credit, then you're going to want to make sure that your retirement date is the day after your last day in active payroll status. And I mentioned this before when we were talking about the sick leave conversion. So this means that you're in active payroll this day, in this example. It's okay if you're on vacation leave, sick leave, comp time, whatever. It's okay if you're on leave that day. It's just that this day is the date of your resignation. This is the day that you write on your letter of resignation to your employer. And in fact, out on our website, on our Ready to Retire page, we actually have a template that you can use to write that letter of resignation that includes these 2 dates. And so this is your date of resignation, and then the next day, that's your first date of retirement. This is the day that you write down on your retirement application. So there's no gap between these 2 days where you're a deferred member. And that way, we will automatically do that sick leave conversion for you to service credit. Now, if there's any gap between those, then that means you were a deferred member for a few days and you lose all your sick leave and you don't get service credit conversion for it. So that's why we kind of stress this idea. Now here, number 6 is a related idea. You want to retire on a day that is not a holiday, and I don't remember what the reason for that is, but the people who do these calculations told me that that's important. So your retirement day should not be a holiday, and you should be scheduled to work the day before. Okay, and it's okay if you're on leave. So for example, if you work Monday through Friday, you don't want your first day of retirement to be Sunday or Monday because you don't work normally Saturday or Sunday. Okay, so going back to the calendar graphic, this day should be a day that you're scheduled to work. Now, for a lot of people, you just work Monday through Friday, and so your first day of retirement could be Tuesday through Saturday, and that's fine. Now, for some people who work in the medical professions, people who work in the safety professions, you might not have a regular fixed schedule all the time. And so you might not be able to choose your retirement date, your exact retirement date, until a little bit later. So maybe you want to choose a retirement week, and then when it gets closer to the time and you see what the schedule is going to be, then you actually choose your retirement date. Because let's say that you're scheduled, it comes time and you find you're scheduled to work in this month, Monday through Wednesday on the 20th through the 22nd. well, then you would want to make sure that your first day of retirement is like either the 21st, the 22nd, or the 23rd. So it's a day after you are on the schedule to work. And again, it's okay if you're on leave that day, but it just should be a day that you're scheduled to work. Okay. And then it says, even if the pay period goes through a Saturday, if you don't work on Saturday, that's a good retirement day. Yes. So for in a lot of cases, the way that they schedule the pay period is like Sunday through Saturday. Okay? But that doesn't matter. All you need to think about is when you are scheduled to actually work, to be at your work site. And if you're scheduled there Monday through Friday, then you can retire on Tuesday through Saturday in order to do this thing where you're going straight into retirement from active pay status. Okay. And does it matter if the retirement date is at the end of a pay period or not? It does not. So just retire anywhere in the pay period that works for you. And then, so then there's a question, what if you flex on Friday? I'm not 100% sure of this answer, but I think if I asked my colleagues, what they would tell me is that you don't want to retire, like if you're trying to retire on a Saturday, you would not want to retire the day after a Friday flex day, because the flex day one Friday on, one Friday off, so you're working like 4 days a week and then 5 days a week every other week. If that's the case, you could retire the Saturday after a Friday where you're normally scheduled to work. And you don't want to retire, just to be safe, on the Saturday after a Friday that you're not scheduled to work. If you want to get an exact answer on that, it would be a good idea to call our call center and get an exact answer to that. Okay, and then finally, don't retire on July 1st. Pick any other day. Because, again, those vacation compensation limits I told you earlier in the presentation would all be lower should you retire on July 1st. Now, I did get a question earlier. Is there a real disadvantage to retiring if not on July 1st, on July 10th? Or how do you find if June 30th is a more perfect date? July 10th, wonderful day to retire. June 30th, perfect day to retire. July 2nd, great day to retire. Any other day but July 1st. As long as you're asking about July 10th or June 30th, as long as they kind of fit all of these other things that I'm telling you, all of these other, 1 through 7, everything in here, as long as the retirement date that you're choosing kind of fits in here, go ahead and pick that date, as long as it's not July 1st. And then let's see, I had another question. So you're age 64. Your entry date is in November of 2012. So you haven't been an NASERA member yet for 10 years. But you'll have 15 years of service credit soon. Can you retire, or will you have to wait until you have 10 years of membership? You bought the service time. Okay. And so it sounds like you are sounds like you're a Tier 2 member, because your entry date is November of 2012, so you got right in before Tier 4. So yeah, the 10 years of membership thing would apply to you unless you have reciprocity with a different retirement system, and then that would not apply. It would be based on your entry date into the reciprocal system. But assuming that you don't have reciprocity, then yes, you would have to wait until that 10 years of membership has passed. So that means you would be eligible to first retire in November of 2022. And that means that You can work all the way up until November of 2022 if you want, but you don't have to. If you're already done working and you want to go ahead and quit, you can do that, and you just become a deferred member. You maintain your membership with Acera, and then you just simply have to wait until November of 2022, and then you can submit your retirement application. So you can do it either way. But yeah, the purchasing of service credit doesn't change your entry date. Yeah, because the service credit, so you'll get the 15 years of service credit in the formula, but it doesn't change your entry date in terms of making you eligible to retire. Yeah, sorry about that. I don't know why they have that rule. I think that's one of those rules that goes like way back to the 1940s whenever Acera started. Okay. And in fact, if you do the retirement estimator, it has logic built into it that won't let you do an estimate for a time that you're not eligible to retire. So let's talk about the process of applying to retire. So we'll do this step by step. Your first step is to go through a preparing to retire section. And there are some details in there that you're going to want to learn about and consider, such as documents that you need to provide to us if we don't already have them on file, changing your account username in your personal account on our website, notifying your department of your departure, etc. And so I'll go back there again just to show you what it looks like. You can either get there by scrolling down here to the Ready to Retire section and clicking on Prepare to Retire, or it's just simply a subsection under Members, which in our website, Members means like active and deferred members. So it's in chronological order based on what you should do first, like verify your retirement eligibility, consider purchasing service credit, and it just kind of takes you down all the way up until instructions on how to actually apply to retire. Going back to the presentation. Step 2 is you set up a Ready to Retire counseling session. And there is a form on our website. You can get to it at acera.org/counseling. Or you can navigate to it. I'll go back to that page that I was just on. It's right here. It's at the bottom of that Preparing to Retire section. So you click on that. You fill out this form, and we encourage you to schedule that Ready to Retire counseling session in the 3 to 6 months before you retire. So within that period, that's when you should go ahead and fill out and submit this form. This gets kind of the ball rolling on our retirement preparations for you and how we do our retirement calculations. When you submit that form, they're going to schedule a counseling session for you within the 90-day period prior to your retirement date. Okay, so in that form, you're telling us what your proposed retirement date is going to be, and when we contact you, we'll contact you to set up that counseling session for that 90-day period, sometime in that 90-day period before you retire. Okay, then you also, during that 90-day period, and this says 60 days, we recently were able to change it to 90 days, extend it to 90 days due to a change in the state law that we adopted. So within, and so I need to change the slide, but within the 90 days before your retirement date is you need to submit your retirement application. And there are instructions for doing that. If I just toggle back to the Preparing to Retire page, that's the final item on the Preparing to Retire page, is applying to retire. And so this takes you through the process in detail, and this gives you the electronic retirement packet, and that's how that works. When you schedule that Ready to Retire counseling session, we're doing them over video now, and you can submit your retirement application during that session, and we will guide you through that whole process. At that time, you're also going to select your retirement option from one of the 5 retirement options. Now, it says currently that you receive your option election agreement 2 weeks before your counseling session. We are currently prepared. We've spent a year working on this, revamping this entire retirement application and making it way more user-friendly and efficient, and we've folded this option election agreement into the application so you do it all in the same form. So if you retire maybe in the summer of 2021 or after, then you'll see it all wrapped up into one thing. But you're going to be making your retirement option election during this period, this 90-day period, and you can also do it during that retirement counseling session. Okay, now on your retirement application, you wrote down your retirement date. Once that retirement date passes, you're retired. It's amazing. You're going to reap the benefits of the retirement that you've been earning throughout your entire career. And your first day of retirement is that day that you wrote down on your retirement application. Okay, so that's the process. So now that you know what day you need to call in for your ready to retire counseling session, it's in that 3 to 6 month period before your projected retirement date. So if you want to, on your worksheet, you can take your projected retirement date and you can just subtract 6 months and you can write that in. And it does say call in. I need to revise that because it should say, so we used to do it over the phone, now we do it on that online form. So that's the date that you need to submit the form. What if you change your date during the counseling session? You absolutely can do that. If you hear something during your counseling session that makes it you think that you're not yet ready to retire, you can change your retirement date. Anytime before your retirement date passes, you can change your retirement date, and the way to do that is you just simply write out a short letter that says, I'd like to rescind my retirement application, and you sign it and you submit it to us, and we'll take your retirement application out of the system. And then you can submit a new application with a revised date later on. You will receive your first retirement check within 4 to 6 weeks after your last employer's paycheck. And if there's any major issues with your file, such as these, missing documentation, pending divorce orders, etc., you're going to get 80% payments initially. And then once we resolve the issues, we'll get you up to your 100% payments, plus you'll get retro payments for any less than 100% payments we had to issue you. The vast majority of people these days, because we revamped our whole system, get right immediately onto 100% payments right from the start. And that's part of why we want you to contact us in that 3 to 6 months before you retire, because that gets the ball rolling on all that stuff. Okay, this is the point in the presentation where I show you the 5 retirement options and explain to you what the different aspects of each one are that you're going to be considering when you choose which one of the options you're going to select. So again, you're making this option election in that right before you retire. So within that 90 days right before you retire, but really it's going to be a little bit closer to your retirement date than that. And you can make it during the retirement counseling session. I want to have a question. What happens in the 4 to 6 weeks with regard to your pay? So you're going to stop working, and then at some point after your last employer paycheck, maybe a couple of weeks after that, you're going to get your last employer paycheck, and then you'll get your first retirement check within that 4 to 6 weeks after you retire, or after your last employer paycheck. In the meantime, you're not getting any payments, and so that's what happens. You're waiting for your Acera retirement payments to start. And for some reason, PowerPoint has frozen, which it occasionally does. So let me go ahead and restart PowerPoint. And yes, the retirement check comes monthly. It's paid on the last business day of each month. And we mandate that you sign up for direct deposit, and so you'll see it basically at like midnight on the last business day of each month. Okay, so here are the 5 retirement options you're selecting between. The unmodified option and options 1, 2, 3, and 4. Okay. Now, the unmodified option is the one that, let me give you some context. For each one of these 5 options, I'm going to show you a slide, and it's going to have a lot of details on it. Now, this line is going to tell you about your retirement allowance that you're going to be getting as a NESARA retiree. These bottom lines are going to talk about what your beneficiaries will receive after you die. Now, your beneficiary, that word just means somebody who gets benefits. In the context of a SARA, your SARA beneficiary is the person that you have named to a SARA to receive your death benefits from a SARA when you pass away. So the unmodified option is the first one. This is the one that the vast majority of people choose because it pays the most to you as the retiree. This is the maximum retirement allowance of any of the options. Now, to the beneficiary, after you die, it pays a 60% monthly continuance. Well, what does continuance mean? Continuance is a continuing payment. So you're getting your monthly payment for the rest of your life, and then after you die, your beneficiary who you name here, who is eligible, will get a continuing payment as well. And so that's what we call a continuance. So in this case, for the unmodified option, it's a 60% continuance. So whatever your retirement allowance was, it's going to be 60% of that. And it can go to a spouse or state-registered domestic partner who you have married or registered with the state at least 1 year before your retirement. And they will get that 60% continuance for the rest of their life. Or, if you don't have a spouse or state-registered domestic partner, but you have a minor child or minor children, they can get a continuance, but it's not going to be for the rest of their life. It's going to be temporary, and it's going to stop at age 18, or it can continue until age 22, at which point it will stop, as long as they maintain enrollment as a full-time student in an accredited school. Unless they get married or they register a domestic partner with the state, and then it will stop. Okay, so lifetime continuance to spouse or state-registered domestic partner, temporary continuance to minor children. If you don't have a spouse or state-registered domestic partner, or if you don't have any of those, you can't leave a continuance to anyone with the unmodified option. But you can name a beneficiary or beneficiaries for a lump sum payment. And a lump sum payment, in this case, is going to be a one-time payment, which is basically a refund of your employee retirement contribution account. So what they're going to get is they're going to get the balance of your account. So it's going to be all of your employee contributions that are in your account that you've paid in through your entire career, plus all the interest that we have paid to that account over your entire career and all the way up to your death, minus all of the retirement allowance amounts that we've already paid you out through your retirement allowance. So it's basically the balance of your account, whatever's left in there. And one thing I will tell you is if you die after the first 3 to 5 years of retirement, there's not going to be a balance left in there because we've already paid you the balance of your account out through monthly retirement allowance payments to you. So we will have exhausted your account. So that's the bad news. The good news is that means that everything that you paid into the retirement system throughout your entire career, you're going to get back within the first 3 to 5 years of retirement payments. And then everything after that is like an amazing bonus that you only get by participating in a defined benefit plan like a SARA. You're going to get the lifetime payment. It's guaranteed income for the rest of your life, no matter what. And what gives us the ability to pay you for the rest of your life after that employee contribution account balance has been exhausted is partially the employer contributions, but mostly the earnings that we've the investment earnings that we've earned by investing the money throughout your entire life and career. And that pays for 75% of your lifetime retirement allowance on average. So being part of a pension system is a very powerful thing, and you can't really get a benefit like this anywhere else. Okay, so having said that, there's one more scenario which I want to mention, which is that at the time of retirement, you named a continuous beneficiary, but that person in retirement, while you're retired, dies before you do. Now, if that happens, you can name a new beneficiary, but not for a continuance. You can only name a beneficiary for a lump sum payment. And that's true for all of the retirement options. The only time you can name a beneficiary for a continuance is at the time of retirement. So like if you get married in retirement, you can name your new spouse as a beneficiary, but only for lump sum payments. Now, even if your contribution account is exhausted, there are some smaller lump sum payments, like the $1,000 lump sum death benefit, any partial month of retirement allowance that we haven't yet paid you out, a refund of advance paid healthcare contributions, and so on and so forth, that would go to that person. Okay, so that's the unmodified option. Let me see. I think I have a couple of questions in here. Okay, so let me take those questions a little bit later. Actually, let me do this one right now just to get it out of the way. Will you please repeat what you said earlier? If you choose to defer your retirement, you lose your accrued sick leave. But you're asking you do not get any payout. You get your retirement allowance. Okay, so what happens is if you don't go straight into retirement from work, and you stop working and you defer your retirement to some later date and then retire, you'll lose all your sick leave, so we won't convert that into service credit, but it's not that much service credit anyway. It's still like a maximum of like 3 months maybe. But you're still going to get to retire from a SERA based on all of the retirement that you've earned, and you're going to get that lifetime retirement allowance. So that's how that works. Okay, so I told you about the unmodified option. Option number 1 is the only one of the 5 options that never pays a continuance to anyone at any time. That's why it's called lump sum to a beneficiary. Now what it does is it pays a little bit less than the unmodified option to you, the retiree, in your retirement allowance. And you'll find that to be true if you look at your retirement estimate. What it does is it allows you to nominate a lump sum beneficiary, and it extends the time that there's a balance left over in your contribution account. Rather than there only being a balance left in the first 3 to 5 years after you retire, it extends it to 10 to 12 years. So if you were to die in that first 10 to 12 years, there would be a balance in your contribution account to pay out to that lump sum as a one-time lump sum payment to your beneficiary. And you can name anyone as a beneficiary. Okay, option number 2 is all of these are going to say that they pay less than the unmodified option because the unmodified option pays the most. Okay, what option number 2 does is it does a couple of things. One is it allows you to leave 100% monthly continuance to a continuance beneficiary. So you name someone and they're going to get 100% of whatever your retirement allowance was after you die. Now the second thing it does is it allows you to name anyone as a continuance beneficiary. It doesn't have to be state registered domestic partner or spouse or minor children. It could be adult children, or it could be another family member or a friend or literally anyone else. So you can name them as a continuance beneficiary. What it does do, though, because it's paying more to the beneficiary, it's going to pay you a lot less than the unmodified option. And the amount less that it pays than the unmodified option is going to be based on the life expectancy of whatever beneficiary you name. So if you name somebody that's significantly younger than you, they have a longer lifespan, so we expect to have to pay them over a longer period of time. So we're going to reduce your retirement allowance ahead of time at the beginning starting at the time that you retire, that reduction is going to be calculated immediately at the time that you retire. And so you're going to get you're going to get less. And if your beneficiary dies before you do in retirement, we don't recalculate your retirement allowance. So whatever your retirement allowance is calculated to be at the time of retirement, for all of the options, that's what it's going to be for the rest of your life, plus cost of living increases. So that's option 2. Option 3 is very similar to option 2. It's almost the exact same thing, except rather than paying 100% of what your retirement allowance was to your beneficiary, they're going to get paid 50%. So all the same rules apply. You can name anyone as a beneficiary. The reduction from the unmodified option is based on the life expectancy of the beneficiary, but because this pays the beneficiary less than option 2, it's going to pay you more than option 2. So you'll get more as a retiree than option 2 if you pick option 3. Option number 4 is pretty much the exact same thing as options 2 and 3. It's the same idea, except you have a couple more options here. One thing that you can do is you can name multiple beneficiaries for a continuance. So under options 2 and 3, you could only name one beneficiary. Under option 4, you could name 2 or 3 or some other number of beneficiaries for a continuance. And basically, whatever continuance we're able to pay would sort of be split up among those multiple beneficiaries. Again, it pays less than the unmodified option. The reduction less than the unmodified option is going to be based on the life expectancy of whoever the youngest beneficiary is that you name. And so you could split it up using a dollar amount or a percentage to multiple beneficiaries. And the other thing that this allows you to do, and the reason it's not on here is because I found out about it recently, you can name one beneficiary or multiple beneficiaries, but you could specify less. You could like customize the percentage. So for option 2, the percentage is 100% to the beneficiary. For option 3, it's 50% to the beneficiary. But let's say that you want to do a different amount. Let's say you want to do 20% to one beneficiary. You could pick option 4, name one beneficiary, specify a 20%, and then you would be able to retain more of a retirement allowance for yourself, but leave like a small continuance to a beneficiary. So that's something that you can do with option 4 as well. Now, those are the rules and details of each one of the options. But if you want to know what the numbers are for you specifically, what you do, and here again is some screenshots of the benefit estimator. You go back to the benefit estimator, you run an estimate, and what you do is you make sure that the beneficiary information you're putting in here is accurate. If you select a beneficiary from this dropdown, if you've already named a beneficiary for your active member death benefits for a SARA, you will probably see that beneficiary listed in this dropdown. And you can go ahead and select them. Just make sure that the date of birth is correct, because some of them are not correct, and it will throw off the estimates. Okay, so otherwise you can just type their name in here and then put in the date of birth and hit get estimate. And then again, you end up with this PDF, and I'll just zoom in here. Okay, so now that you have heard about the different options, these maybe this makes a little more sense. So here's the estimate for each one of the retirement options. And so now you'll notice a few things. The unmodified option, so this column is the member allowance, that is your retirement estimate for your retirement allowance, and the beneficiary allowance is an estimate of the continuance that the beneficiary would get after you die. So you'll notice that the unmodified option is the biggest number on here. And then you'll notice that the beneficiary allowance is 60% of the member allowance. You'll also notice that for option 1, there is no beneficiary allowance because it doesn't ever pay a continuance to anyone. And you'll also notice option 1 is a little bit less than the unmodified option. For options 2 and 3, for option 2, you'll notice that the member allowance and the beneficiary allowance are the same, because remember, it pays 100%. And for option 3, you'll notice that beneficiary allowance is 50% of the member allowance, and also that option 3 is bigger than option 2. Okay. Option 4, because there are so many customizations you can make, we can't really use the benefit estimator to give you an estimate. So for that, you need to submit a retirement estimate request form to us and specify how you want us to calculate the estimate, and we'll do that for you. There's a couple of other numbers here. Let's see, I'm getting a request to zoom in. Let me see if I can do that. I don't think PowerPoint lets me do that, so I apologize for the smallness of that. Maybe I'll come in here for a later seminar and actually just zoom in on this part. So yeah, I apologize for that. For option 1, you get another couple of numbers here, and what this does is this helps you figure out how long your contribution account balance is going to last. And so it gives you the total amount that is going to be paid out over time here in this big number. And then the little number is the amount that is going to be deducted from that balance each month that you receive a retirement allowance payment. And so in order to figure out how long there's going to be a balance left over for your lump sum beneficiary, all you do is you take the big number and divide it by the little number, and that will tell you how many months that is going to last into the future. And you can even divide it by 12 and it'll tell you how many years it's going to last. And that will, like I said, it should last 10 to 12 years. Okay, I have a question. Can we change the option we select after retirement? You cannot. Your only opportunity to select your option is at the time of retirement. Now there is one scenario where you could change it, and that is if you have a disability and you are waiting. The disability retirement process takes a long time to go through. It can take up to a year. And so if you need to go ahead and retire under a service retirement, which is the regular retirement, you can do that. And then if you are awarded a disability retirement later, then you could change your option upon being awarded the disability retirement. But that's the only scenario where you can do that. Otherwise, whatever option you pick at the time of retirement is the option that you're going to have for the rest of your life. Okay, you are welcome. Okay, so at this point, we're going to talk about healthcare benefits, and I'm going to go a little bit over because this takes a little bit longer than the 15 minutes we have left. So the post session might start a little bit late. So just to let you know about that, like I mentioned at the beginning of the presentation, this is all going to be video recorded and available on our website. So if you've got to go, you can come back and watch it later whenever we post it. Okay. So let me just check on one thing here. Okay, I've been talking a lot about the guaranteed benefits that if you remember, we named them the vested benefits. So there are other benefits that are offered that are non-guaranteed benefits. They're non-vested benefits. These are offered because at some point in the past, the county decided that the retirees needed these extra benefits to pay for other aspects of their lives in retirement. And so they started a reserve fund that pays for these benefits. And what the Board of Retirement does at ACERA is they determine what the benefits are and which retirees are eligible to get the benefits and what the levels of benefits are that are paid out of this fund in order to ensure that the fund stays sustainable now and in the future. So these benefits could be reduced or adjusted in the future going forward. So that's just how it works. I will say that ACERA offers a much higher level of these extra benefits than any other county in California. The rules that the board has set up for who qualifies for these extra benefits are based on years of ASERA service credit. So you can see that for the supplemental cost of living adjustment, which is an extra cost of living adjustment on top of the guaranteed one, there's no years of ASERA service credit to qualify, so everyone qualifies for that. For all of the other benefits, it starts at 10 years of ASERA service credit. So there's subsidies for dental and vision and Medicare, and then there's this one called the monthly medical allowance, which is what MMA stands for. And there's 3 levels of subsidy for that, and the first one starts at 10 years, and then you get more at 15 and more at 20 years of ASERA service credit. So let me tell you about each one of those. Now, starting with the monthly medical allowance. So again, it's a non-guaranteed benefit, and it's for offsetting the costs of ASERA-sponsored medical plans. So no outside plans. We have 2 types. We have group plans and individual plans. And for the group plans, it offsets the cost of the monthly premiums only. And for the individual plans, it can actually offset the cost of not only the premiums, but co-pays and deductibles. The amount is set annually by the Board of Retirement. So the amount of the monthly medical allowance, what the allowance is set annually. You, the retiree, are responsible for any costs exceeding the monthly medical allowance. And there often are costs that exceed how much the monthly medical allowance is. And it's not available for beneficiaries, survivors, former spouses, dependents. It's only available for you, the retiree, to cover your expenses. Here are the monthly medical allowance amounts for 2021. So these change every year, or they can change every year based on what the Board of Retirement decides to set the monthly medical allowance at. You can see that at 20 years of ASERA service credit, you would be eligible for the full monthly medical allowance, and the amount is $578.65 per month. If you have at least 15 years of service, you would be eligible for the 3/4 amount of that, which is $433.99. And if you have at least 10 years of ASERA service credit, you're eligible for the half portion of that, which is $289.33. So those are the amounts. Let me show you the plans, and it will give you kind of an idea of how much of the plan costs the monthly medical allowance will cover. Okay, so here are the plans. Our open enrollment is each November, and it's the entire month of November, and this is your chance to choose a new plan, change plans, enroll, disenroll. Otherwise, you are enrolling in plans at qualifying events, but retirement is a qualifying event. So we can get you right into a plan with no gap in coverage, and we always do that. We have a healthcare unit that will help you through that. So the plans are divided into 2 categories based on whether you're Medicare eligible or not. And Medicare eligibility starts at age 65 in general. And so if you're over age 65, you're choosing a Medicare plan. If you're under age 65, you're choosing a non-Medicare plan if you want coverage through ASERA. And there's 3 companies here. There's Kaiser Permanente, United Healthcare, and Via Benefits. So what I'm going to do is show you the group plans, non-Medicare and then Medicare, and then I'll show you all at the same time the individual plans through Via Benefits because it's easier to explain it all at once together. I'm just kind of showing you basic info. If you want the full details of each one of the plans, we publish an enrollment guide every year, and it's available out on our website. And in retirement, you'll get this in the mail every year before open enrollment. So here are our non-Medicare group plans. There's 3. There's Kaiser Permanente HMO, and then there's 2 United Healthcare HMOs. One's called Signature Value, and one's called Signature Value Advantage. Now the advantage of the Signature Value Advantage is that it's a lot cheaper. And in fact, it's our most inexpensive group plan currently, which is new for this year because usually before it was the Kaiser Permanente HMO. You can see the cost is $759.16 for the cheapest plan. And if you recall, even the 20-year monthly medical allowance won't cover the full cost of this because that was, I think, $578 and change. So
you would be responsible for paying the difference of that. And then you can enroll your family members, Self Plus One or family. The copays are $15. And then there's a little more information here about the Signature Value Advantage plan. The difference between these two plans is that for the Signature Value Advantage plan, you have to stick to this high performing network, which is like high efficiency medical providers. But what the county found when they studied this was that everyone who was in the Signature Value plan was already going to these providers anyway. And so they should just switch to the Signature Value Advantage plan and save a lot of money every month. And so it's 6% cheaper than even the Kaiser Permanente plan. Okay, the way it works with the monthly medical allowance is this is a very crude illustration of your Acera check stub. So here's you, John Jones, and your gross pay on this check stub is $4,000. So this is your Acera retirement allowance. Now in the deductions column, you'll see if you enroll in one of our medical plans, you'll see a line for that. And you'll see that money come out of your check. And what we do is we take your premium amount each month and we send it over to your healthcare plan for you as a courtesy to you. What we also do is if you're eligible for the monthly medical allowance, we put that back into your check in the same check. And so you end up paying the difference. So in this case, this person signed up for Kaiser Permanente, and they have the 20-year monthly medical allowance, and then they end up paying the difference, and then this becomes their net pay. This, like I said, it's a crude illustration. There's also going to be tax withholding in here and perhaps a few other deductions. Okay, so that's the individual, those are the non-Medicare group plans. Now here is the Medicare group plan. This is the only Medicare group plan option for you. For all of these group plans, there is a service area that you have to live in order to enroll in the plans, and the service areas for these plans are the San Francisco Bay Area, Sacramento, Fresno, Southern California, and for Kaiser, I think they also have Santa Cruz. If you live outside the service areas or outside the state, you cannot enroll in one of these group plans, but there's an individual plan option for you, which I'll get to in just a minute. Okay, so regarding the Kaiser Permanente Senior Advantage Plan, which is a Medicare plan, the way this works is you enroll in Medicare Parts A and B. And then this plan kind of fills in some of the gaps that Medicare doesn't cover. So it gives you a higher level of coverage than Medicare alone. And you can see that even with the 15-year monthly medical allowance, it's still larger than the monthly premium amount for this, which is $382.21. And so it basically costs you nothing to be enrolled in this plan. So you might as well, if you have at least 15 years of Acera service credit, go ahead and enroll in it because it gives you a higher level of coverage than Medicare alone. And for this plan, what I've done on this slide is to just put in the 20-year monthly medical allowance in here and subtract it out of the premiums just to kind of show you what the out-of-pocket cost would be. And we did that with all the plans in that guidebook. Okay, so those are the group plan options. Now for the individual plan options. Who can enroll in an individual plan through Via Benefits? Via Benefits is a private health insurance exchange that we have contracted with to provide individual plan enrollment for Acera's members, for Acera retirees. And if you're not yet Medicare eligible, and you live inside the US, but you live outside one of Acera's group plan service areas, you can enroll in an individual plan. If you live in the group plan areas, you got to enroll in a group plan if you want coverage through Acera. Now for people who are Medicare eligible, we don't care where you live in the US. You can even live in the Kaiser Permanente Senior Advantage Group Plan area. That's fine. You can still enroll in an individual plan through Via Benefits. You just have to enroll in Medicare Parts A and B, and then you can enroll in Via Benefits. And so I got a question, does this monthly medical allowance last until you die, or is there a cap? it's probably going to be available for the rest of your life. It's based on the sustainability of that reserve fund. And so in that reserve fund, there's about $930 million in there currently. And it's considered currently very sustainable by the board. And so there's probably going to be an amount in there for retirees for the rest of your life. But what the benefits are and how much they pay is going to be adjusted every year by the board to ensure that that fund stays sustainable now and in the future. So there's not like a cap per se on this, but what the benefits are and how much they pay changes from year to year. And so you just kind of have to follow what that is. I got a question, is moving out of the country bad? Well, that's up to you if moving out of the country is bad. I would say, like, on the one hand, you cannot enroll in a medical plan through ACERA because we don't sponsor any plans outside the US. But on the other hand, most of the rest of the world has national health care. So you can just get national health care through whatever country you move to. So that is up to you. Okay. Regarding VIA benefits, there are 80 or more insurance carriers that VIA benefits contracts with to offer individual plans. Okay. And when I say individual plans, for the group plans, the risk pool is like the pool of ACERA retirees that are enrolled in the plan. For the individual plans, the risk pool is the entire population of everyone who is in an individual plan with VIA benefits. So it's like an expanded risk pool. But on the other hand, it's still like an individual plan, individual to you. So you're not in a group. The service area is nationwide. The enrollment is over the telephone or online. And the way it works is that when it comes time to enroll in this, most people will call into VIA benefits to talk to a certified salaried, non-commissioned, non-biased benefit advisor. And I say all that because they're not getting a commission based on which company they send you to get your healthcare insurance. They are just are salaried, and so they're just narrowing down the plan to what's right for you. So you're gonna tell them where you live, what kind of doctors you want to see. You can even get as granular as what prescriptions you need. You can tell them how much you want to pay, and they will narrow down their 1,000 plans into just a few plans that you can choose from, and they'll send you more info on those, and then you can enroll in one of those plans. And like I said before, the monthly medical allowance pays for not only the premiums, but also deductibles and copays. The way the monthly medical allowance works with the VIA benefits plans is different than the way it works with the group plans, because the monthly medical allowance doesn't go in and out of your ACERA check, and we don't take the premium out of your check for these individual plans. Okay, here's how it works. If you're eligible for the monthly medical allowance with ACERA, what we're going to do is send your monthly medical allowance that you're eligible for over to VIA benefits. Okay, so here's VIA benefits in my second crude illustration about how money moves around. So VIA benefits will open a health reimbursement account for you, and ACERA sends your monthly medical allowance over to your health reimbursement account at VIA benefits. Now over here, you're going to enroll in a individual healthcare plan, and VIA benefits is going to help you do that. You're going to owe a monthly premium to that insurance company that you enroll in, and so you're going to pay that out of your bank account. Okay, then you're going to take advantage of your health insurance by going to the doctor, and they're going to charge you a copay. So you pay the doctor the copay. So you're out some money here. So what you do is you submit a reimbursement claim back to VIA benefits, and they'll pay you your monthly medical allowance back to your bank account. And you can have a lot of these transfers set up electronically and automatically, and VIA benefits will help you do that when you enroll in the plan. Okay, now this chart is only for the Medicare plans for VIA benefits. And if you're eligible for the monthly medical allowance as a Medicare, if you are an ASERA retiree who is Medicare eligible and you want a individual plan through VIA benefits and you're eligible for the monthly medical allowance, because the VIA benefits Medicare plans are so inexpensive, the Board of Retirement decided that they would have a slightly reduced set of monthly medical allowance amounts just for those VIA benefits Medicare plans. And so that's what this chart is depicting. Now, for the people who are non-Medicare eligible enrolled in individual VIA benefits plans, it's still the same monthly medical allowance amounts that I showed you before. So that's medical coverage and the medical subsidy known as the monthly medical allowance. Now let me talk about dental plans. We have two dental plans that you can enroll in. Delta Dental PPO, which is a nationwide plan, and Delta Care USA, which is a California-only plan. If you have at least 10 years of ASERA service credit, or you have service-connected disability retirement, you must enroll in one of these plans, but it costs you nothing. The premium that you pay to Delta Dental and the subsidy that ASERA reimburses you for are the same. So we reimburse you for 100% of the monthly costs of being enrolled in these plans. So that's why this column is saying this, the self-premium and the subsidy are the same. So if you were to enroll, for example, in Delta Dental PPO, and you have at least 10 years of ASERA service credit, you would see in your ASERA retirement check, you would see $44.15 come out of the deductions column, and you would see $44.15 go back in the additions column. And so you would end up paying zero. And one side note I would like to point out, for all of these subsidies, all these healthcare subsidies, is they're not taxable income. We have it worked out with the IRS that you don't have to pay income taxes on this. It's not taxable income. Okay, now you can enroll your family, so yourself plus one, or your family in these plans. Again, the subsidy only covers the cost of your enrollment in the plans. And then if you have less than 10 years of ASERA service credit, you can voluntarily enroll in one of these plans, but you have to pay your whole way through it, and there's a different set of premiums for you. Vision works the same way as the dental. If you have at least 10 years of ASERA service credit, you have to enroll in the VSP standard plan, but it doesn't cost you anything. And the self-premium and the subsidy are the same, $3.97 per month. And you can buy up into a VSP premium plan, and one of the features that it gives you is frames every 12 months instead of every 24 months, like the standard plan, but you pay the difference. The subsidy doesn't increase if you buy up into the premium plan. And again, if you have less than 10 years of ASERA service credit, you can voluntarily enroll in the plan, but you have to pay your whole way. Okay, so that's medical, dental, vision. The fourth non-guaranteed benefit I want to tell you about is the Medicare Part B reimbursement plan. Okay, at some point in the future, you're going to be retired and you're going to be eligible for Medicare. And at that point, you are going to enroll in Medicare Part B, and you're going to start incurring a cost that the federal government is going to charge you for being enrolled in Medicare Part B. And currently, the lowest level of that, the lowest cost for that is $148.50 per month. That's for 2021. So what ASERA will do is, if you have at least 10 years of ASERA service credit or a service-connected disability, ASERA will pay you that same amount, $148.50, into your retirement check to cover your whole cost of being enrolled in Medicare Part B at the lowest level. Now, if you have a higher income, the Medicare Part B charge, the price is tiered. So you could incur a higher cost, but then the subsidy is going to stay the same, $148.50 for everyone. And so you just have to enroll in this one time and just maintain enrollment in Medicare Part B. And when it comes time for you to enroll in Medicare, what you want to do is attend one of our Medicare transition seminars, which you can enroll in on our website under the News and Events menu. And you're going to want to do that within kind of like the 3 months before you turn 65. If you're still working and you're already 65, you should not enroll in Medicare until Medicare Part B at least, until you retire and stop working. But there's more information about that in our Medicare transition seminar, and you can watch a video of that out on our website as well if you don't want to attend the seminar. And the fifth and final non-guaranteed benefit I'll tell you about is the supplemental cost of living adjustment. So this is in addition to the guaranteed cost of living adjustment. And what this does is it maintains your buying power in retirement to at least 85% of what it originally was at the time that you retired. So if you ever lose more than 15% of your buying power to inflation in retirement, then the supplemental cost of living adjustment kicks in and keeps you right at 85% of your original buying power in retirement. So you can't lose more than 15% of your buying power in retirement. And it's a really powerful benefit. Okay, this is the second to last thing that I'll tell you about. Second to last slide I have, and then I'm going to turn it over to Gene Hilliard from the Deferred Compensation Program. I'm just going to touch on each one of these bullet points really quickly because not everybody, these life events don't apply to everyone. I just want to tell you that this information is out there and these concepts exist. So if you're going to defer your retirement, which means you're going to quit working before retirement, there are some things you might want to know about that, and you should go ahead and read our deferred retirement page, acera.org/deferred. There are death benefits available should you die before retirement. And so it's good to know what those are. And you can read that on our death benefits page at acera.org/death. And it's good to go ahead and keep your beneficiary up to date right now. Like who's your beneficiary? Do you know who that is? Maybe it's somebody that you used to know. If you log into your account on our website, you can see who your beneficiary is. And if it's your spouse from like 3 spouses ago, you're going to want to redesignate your beneficiary immediately. And there's instructions on that beneficiary page in your account on how to do that. And then regarding divorce or domestic partnership dissolution, there's some things you're going to want to know about that and how it affects your ACERA benefits, or how it could affect your ACERA benefits. So go ahead and read our divorce page. Disability retirement is something I referred to a few times in this seminar. If you become permanently disabled and you can't perform your job duties, you can't apply for the regular retirement, or like you can't go through with your retirement planning that you were planning. But you can retire early with a disability retirement. So you should check out the information on our page about that. If you're going to work after retirement, especially if you're going to go work for anyone except for our 6 participating employers at ACERA, we don't care. We're going to consider you retired. We're going to pay you your retirement allowance starting with your retirement date and every month for the rest of your life. So you can go work for anyone you want. Now, if you are going to come back to work for one of our 6 participating employers, then there are some restrictions on that, and you're going to want to check those out on this Working After Retirement page. And then finally, if you move after retirement, you should go ahead and tell us, change your address with us. And so there's information about that, and it's pretty important to do that. Finally, I highly recommend signing up for ACERA email news. We only send out important stuff. We hardly send out any email news because, not that much news happens with in the retirement system. Things change really slowly. But occasionally there is something really important that we want to let you know, and so I recommend going ahead and signing up for that at acera.org/subscribe. And I got a question really quickly. What about retired annuitant? That is what I'm talking about. That's retired annuitant is the term for you going back to work for one of our participating employers or going back to work for your employer. And in that case, you're going to want to go ahead and check out that page about working after retirement to see what the restrictions are around that. And a quick question, MMA doesn't cover the spouse. That's correct. It only covers the ACERA beneficiary. The other 2 questions, I think we're kind of out of time, so I'll take those at 12:45 after the deferred compensation program is over. But we do have a call center. You can call us at any time. The phone number's out on our website. And I'm going to go ahead and turn it over to Gene Hilliard.